Okay, good afternoon, everybody. Welcome to the weekly take on the market. Today is Friday, February 23rd. It is 1:06 p.m. Pacific time. Market just closed. I will be your host. My name is Scott St. Clair. I'm the manager of the Premium Product Group here at Investors Business Daily. Uh, Disclaimer, very important. Can't tell you what to buy, sell, hold, how much to have. I can't tell you whether XYZ is a perfect cup with handle. Just everything kind of falls under the compliance umbrella. These webinars or these videos, since they're vetted with this disclaimer, I can speak a little bit more freely on them, but I'm not licensed. Nobody here at IBD that I'm aware of is licensed. Okay, so market thoughts, industry groups, stocks to watch, quote of the week, everything will be pretty much the same. And let's start with market thoughts. I've talked about the presidential cycle. So I thought this was interesting. Every time since 1944, US president was running for reelection, stocks posted gains for the year, regardless of who won. So there's something to cycles. They give you kind of a headwind or a tailwind. Feel like the market has a tailwind this year because of the cycle. But does that mean that I'm gonna ignore the signals I see if the market's giving me signals? No, but I tend to err on the side of bullishness. So when the market's pulling back, I tend to, look for stocks to buy. I still love to ring the cash register. So when the market's running hard, I like to take some off. I don't know if that'll ever change for me, but so far, the market's never easy. I don't like when they say, "What was easy in 1999, or it was easy in 2000, or it was easy in 1982." I don't believe that. I don't think it's ever been easy. I think you could say it's been easier than other time periods or harder than other time periods. But I went through the 1990s cycle, and I've got a lot of friends that I grew up with in the business, and unfortunately, some of them are broke. Some of them have a lot of money. So, it just kind of was. It depended a lot on the person. So I feel like the market a little stretched here. Probably get some kind of pullback consolidation. The Nvidias of the world. I think Nvidia went up yesterday as much as like the entire country of Canada, and Nvidia is now worth more than Chinese stock market. And you start to see all that stuff. And I remember that a lot of that in the 90s. You saw a lot of that. Uh, I just don't think that's, I mean, it's fun, it's neat, it's interesting. And, in a vacuum, I just don't know how you could make any money off of something like that. So we're in a bull market. It'll end when it ends. That's why we have rules for getting out of stocks, and just try to stick to the rules as best you can. Um, that'll steer you in the right direction. Uh, this is interesting from 314 Research. So normally, at least in my experience, Wall Street strategists always have a target that's higher than where the market is. So if the S&P is at 5,000 on January 1, you look at all the strategists, you'll have one guy or girl at 5,100, and you'll have one at 6,500, and then you'll have a bunch in between, but it's almost universally positive. It part of it is it just doesn't pay to be bearish as a strategist. If you're right, there's no reward really, and if you're wrong, there's tremendous risk, career risk. So most of them, if I was a strategist, I think I would do the same thing. Just because you have a good career, you got a great job, you work for a really prestigious firm, you just don't want to lose that. So, but they're surprisingly not all that bullish on their targets currently. So there is a little bit of disbelief on the stock market, uh, because and there's 100 reasons why, but because of the lack of breadth, and it's just the Nvidias of the world that are going up, and all of this stuff that you might hear, but I don't think that's necessarily true. I've talked about that. There, if you only had to, I guess if you have to have 300 stocks as a mutual fund, it might be tough. But if you need, 8 to 13 stocks as an individual investor, they're out there for you. So this is the lack of bullishness is good news, I guess. All right, before we jump to industry groups, let's go to the charts. Let me turn my camera off. So you can see the chart. So here's the NASDAQ, pretty much up to date. And it looks, pull back, and then here's the gap up on NVIDIA. And and the market's a little, the word that we hear a lot is extended, which is not one of my favorite words, because I'll be honest with you, I thought the market was extended there. Extended. So, when you look at it, oh, it's extended, but there's a reason it's extended. Institutions are trying to put money to work and they can't get the pullbacks they want. So, that happens a lot in bull markets. It stays extended. But I have a friend that does a lot of work with Tom DeMark, the DeMark indicators. Some of you might know of those. And the market's some of the best stocks out there, and the indexes are pushing, if you know what those, they're pushing 13 counts. So if you're interested in that, and what does that mean? It think about it like the other way around. Like if NVIDIA and ServiceNow and Meta were all pushing towards their 50-day, they were all near their 50-day moving averages, that would, you'd kind of be in an area in the market where you'd want to take notice. They could bounce off the 50-day, or they could break the 50-day, and then everything would be, the opposite. And so when you get exhaustion like that, you just want to kind of take notice. And I think when you see SMCI do what it did, or NVIDIA, what are some of the other ones? The ANF, they just look like they should be exhausted because they've made big runs. So I'm hoping that cycle plays out where we get a bit of a pullback for a couple of months. It's based on that chart, wouldn't be that big a pullback, maybe down to the 50-day or something like that would be nice. Maybe even if it undercut there and shook everybody out, you could get something like that. But that's kind of how I'm looking at the overall market as we sit here. Let's look at the S&P. One thing I will say is, the market could have easily had a give back today. Probably not like that, but you had such a strong day and it just doesn't go down. The S&P was actually up, the NASDAQ was down. So it's just really a very resilient tape for sure. The diamonds, I guess, the Dow. And I don't know if Amazon is already in this or will be, but now they're adding Amazon, so maybe the Dow will get a little bit more relevant if they add a few different names. So I still have a lot on the market. I think it wouldn't surprise me if it consolidated and pulled back, but we're in a bull market, so I have my favorite stocks that I just want to kind of try to hold through, but I don't want to be over my skis, because if you can't, I'm not good at handling pullbacks. So if the market did that, if the market, did this over a number of days to weeks, remember this is 5-6% on the index. What is that on the leading type stocks? 1.5 to 2.5 times that. So that'd be pretty tough pullback for me to handle. So I need to be positioned accordingly. At least that's how I handle it. And I'm not sure Well, I guess since it's on my mind, I'll talk about it. Uh, are we in a bubble? Is this like 2000? Blah, 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 all of that stuff. And I don't think so. I don't think it's like 2000. It has a few similarities, but 2000, there was so many more names to buy and everything was moving and lots of new issues. Um, you had lots of like, let's pull up like Juniper, and a lot of these stocks don't exist anymore, unfortunately, but here's Juniper. Yeah, it comes out of this IPO base, goes up 40%, builds another base, runs up 200%, very SMCI like, does a 3-for-1 split. I mean, it just has all of the trappings of and this is just Juniper is one of probably 100. There were 100 Junipers back then. It's much different in that regard. This is more concentrated in the really big stuff: Meta, Nvidia, SMCI. What else is acting unusually powerful? ARM Holdings, although it's an IPO, it really isn't. It's a mature company. But so that seems different to me in that regard. But if you think that that's the case, which is fine, I would go back and study these names and look at how they topped. So like I think the key names that I could think of that are still in our database: Intel, Cisco, Microsoft, Schwab, Apple, Oracle. Although Apple was not that great a stock back then, it still did very well. Dell is in our database, but they went private and then came back. So once they went private, we lost some of that trading history, unfortunately. But like Intel topped in late 2000. So let's go to like November of 2000. And you can see how, if we look at a weekly, so here's March 1995. That's when I first started trading, opened up my own personal account. So you can see how, huge tailwind. Not every base worked, but, breaks out, works, breaks out, works. And you get kind of a later stage base. And the key is, and I'm fairly certain, maybe it wasn't this day, because I remember the day being really bad. Maybe it was this day. Yeah, this is an earnings report. I'm almost certain of that. And the earnings report was really poor. And that's how Intel topped. So it breaks out of a really ugly base, kind of a terrible cup with handle, stops you out, maybe drags you back in, stops you out again. And that's how Intel topped. So if I fast forward, that's the top. The stock is more than in half by the end of 2000. So late stage base failure was how Intel topped. How about Cisco? Very, very similar, late stage base failure. So 9 of 2000. Let me go back. I want you to see it. I want you to see how the base that it was building. Maybe 1 or 2 more weeks. There it is. Okay. So cup, flat base, it worked really well. And then you build this double bottom. And as we fast forward, like it never could get going, right? So here you are. Look at the relative strength. Look at the relative strength line. It's just getting worse and worse, just going sideways. A pattern rec is turned off because it never broke out. So it's no, now the 40-week line has caught up to the stock And look how it's respected that line almost the whole way, except in the, the Asian crisis bear market, it did build a base. But the line has quickly is caught up. And then now you're starting to live under that line. So that's really a bad sign when a leading stock is under the 200-day / 40-week. And look at the relative strength line. So this is topped by this point, and it was resilient. It held up as best it could all the way into 2001, but ultimately, hard to believe, 80 down to 18, and maybe even, I think it might have even gone to single digits. I think it bottomed around 8, if I remember. Maybe. No, maybe I'm thinking of Yahoo. I think Yahoo went to single digits. I remember I was short Yahoo when it broke 10, thinking that it was probably going to 0. I think it got as low as 8 before it rallied and ran me over, if I remember correctly. So that's how Cisco topped. Yahoo is Yahoo. I don't think Yahoo's in our database anymore. Yeah, unfortunately. So Microsoft. So here's Microsoft breaks out of a base. It goes up 23% in 3 weeks. Doesn't really work. Builds a whole new base. Late stage base failure. That one topped like that. So you have another late stage base failure. And we're all looking for climax tops, but that really is very rare. At least that's my experience. So Charles Schwab was a climax top in 1999. It actually tried to break out of a new base and get going. And you see, like, you probably want to buy that. It looks very strong, and then just gets really sloppy. And a characteristic of these stocks is, what's something you notice about that? Like every bar is like a 5% bar practically from high to low. So they just get really wide and loose and choppy, and just makes it really hard. Cisco, like, look at how Cisco was a really volatile stock, but look at how tight it is here. And even here, it's not too bad. But then in here, it just gets really, it's just a little bit looser. So Schwab was an AOL. They were climax tops. How about Apple? So builds this late stage base, never fails, never breaks out. I know it says it's a cup with handle because it undercut that low, but it's a little, everything to me by 2000s, a late stage base. I mean, the market's been, barring the Asian crisis, which is kind of like the COVID bull market. It was short and sweet. Now, short and sweet back then was a little bit longer than it is nowadays, but it was a pretty short and sweet bear market. Let me put the index across the top. Right in there. You can see it's like a blip hardly, but late stage, it's basically just failed. So you wouldn't have bought it, or if you did, you should have stopped yourself out before it blew up. And then Oracle, if you bought that, you're stopped. The sell rules protect you. So I'm sure there are other names that are in our database, but these are the ones that I thought I would go over. And so if you're worried about it, then you say, okay, well, SMCI, maybe that's the Schwab of this cycle. And you had a climax top. Oops. I'm doing it wrong. SMCI, Scott. And, maybe fast forward, it'll still be 800, but really wide and loose. That's a possibility. But the NVIDIAs of the world, they're the ServiceNows, the Microsofts, the Metas, they're probably going to build bases and fail. That's based on history. I think that's kind of how it'll play out. So if you have a plan, you should be fine. You shouldn't have to worry so much. The Nasdaq's just not going to be like barring some unforeseen exogenous event. It's not just going to be 16,000 one morning and 14,000 the next. It just doesn't really work that way. All right, so let's go to the industry groups. Hardware, peripheral, apparel, shoes, semiconductor, biotech, energy, coal. Coal is still holding up, even though stocks aren't doing a whole lot. Finance, card, computer, software, security. So I like the transportation, shipping held up, but this not a lot there that seemed actionable. I looked at that. So go through the groups. I know I think Square broke out, although it was an earnings gap. And then there's another one. Now this isn't an IPO, even though it's an IPO on the Nasdaq. It does trade on the London exchange and has for a while, but um, in that group. And then I mentioned Adyen, so maybe that group is making a little bit of a comeback. All right, so let's stocks to watch. Melly just kind of highlights, how tough earnings are. The earnings were flat, revenue up 42%. And the stock actually held up pretty good considering that report. I do not have a position. Oh, I do. I have a position in that KSPI that I just mentioned, FYI. I do not own Square or any of the other stocks that I mentioned from like the Intels and Cisco's of the world. I think if I owned Melly, I don't. I probably would have just got out today, and just kind of revisit it later. But it's been a good one, but that's not great action. Nvidia, look, it's tired, probably needs a rest. The earnings just incredible. Look at those three quarterly reports. I don't know. I can't recall anything like that outside with the size. Obviously, with the size of Nvidia, it's unprecedented. Do you remember Ascend Communications? Not in our database anymore. Jim Ropel talks a lot about that one, but I remember that one having triple-digit earnings and sales, like quarter after quarter after quarter, and stock went bananas to the upside. It was a tremendous stock. So that's what happens. Stocks, they move on earnings. Somebody had a Substack I thought was interesting, and and it was like, well, Nvidia's up, and I'm just throwing out numbers. I'll have to find that Substack and maybe use it again, or actually quote it. But like Netflix, the earnings are up 20-fold in the last 20 years. Stocks up 19-fold. Nvidia, the earnings are up 8-fold in the last X amount of years. The stock's up 8.5-fold. It was really incredible how closely over long periods the stocks that he mentioned, what the earnings were up and what the stock was up. Earnings, earnings, earnings. The earnings drive these stocks in the long run. In the short run, anything can happen, but in the long run, it's what drives these stocks, and that's why some smart people that that are really good market operators, they think Nvidia is undervalued, and it's like it makes people's heads explode when they think about that. But if the earnings are going up faster than the stock, then that would make sense. So I don't have a position in Nvidia, or have a synthetic position in Nvidia, and a synthetic long in the option market. So it's not really a very big position, which is why my first instinct was I don't have a position in it, but I forgot I have a small option position in it that's I need the stock to basically go up or sideways, and that's kind of what I think is going to happen in this area. SMCI is a trading sardine. If you're interested in it, Linda Bradford Raschke wrote the book Trading Sardines. For the sake of brevity, I'm not going to tell the trading sardine story, but it's a very funny story. And SMCI to me is a trading sardine. You can't invest in this anymore. You want to trade it, yeah, it's very tempting, but boy, it's risky. When you get it right, it's just so rewarding. But man, when you get it wrong, it's like when it takes your head off in 5 seconds. So it just feels like, at least for now, it's topped. Um, and proceed accordingly. So let me just go in order of what I have here. PDD. PDD is interesting to me. It didn't have very good day today. It looks like it needs a base, but like if this is a relative strength line versus China, PDD would be like this. So it's the leader in the Chinese space, I think. So if the Chinese market ever gets legs, I think this is the go-to stock. So that's why I watch it. ARM, again, it's IPO, but sort of. 80% of the stock doesn't exist, owned by SoftBank, but holding up really well. If I look at the daily, looks really good. I don't have a position in this. It's just almost somewhere in there. It's kind of, I was hoping it would kind of come down a little bit more, and it's kind of got missed my chance on that one. COHR, I do have a position in. 2 weeks tight, so maybe it'll do 3 weeks tight, something like that. So not that all that exciting after gapping up on earnings, trying to give it a chance to do its thing. Powell Industries, huge gap, just a beast. It's super thin and super small, 9 million shares in the float, but earnings up 999%, right? 999, 288, 800. So it's just been a beast as far as that. I've already so I did talk about the KSPI coming out of this. It's not sort of an IPO base, but it isn't. It's got action over here in the London Stock Exchange. Look, these earnings are really, really incredible. And 99 EPS rating, and look at the annual earnings, 3, 5, 6 estimates. If this was XYZ in the US, it'd be going gangbusters, I think. It's Kazakhstan-based payment processor. They say caveat emptor or whatever. In other words, do your own due diligence. I actually watched a hour-long YouTube video on the guy explaining this. Is he was, for lack of a better word, pitching the stock to a investment group, and I watched it just because I liked the technical action of what the stock was doing. So again, you have the risk of the overseas and the country that we don't know that well, but gosh, those earnings and sales are very interesting. CrowdStrike, great action. I do own CrowdStrike. I bought it here. Palo Alto gap down on earnings, and CrowdStrike and Zscaler, they gap down too, but look how they closed. So strong. So there's Crowd. Zscaler, much bigger gap, but had 2 better days after that. So Crowd did most of the work the first day, and it's filled in the gap as well. So Zscaler and Crowd, they seem like the leaders. I know there might be others, but they seem like the leaders. And Palo Alto would just be off my radar. It just would be not anything I'd be interested in. So Crowd, Zscaler, Palo Alto. What about Meta? It needs time, needs a base. VRT needs time, needs a base. The only thing I'll say about VRT is 360.24, 126.18, 113. Looks like it's decelerating to me. Still good, but decelerating. ANF, I can't explain this stock. It's just like incomprehensible to me what it's done. I don't own it. Haven't owned it. I almost thought about shorting it just out of spite because I was tired of watching it go up. But just an incredible stock, earnings in 12 days. I don't know. I just don't know what you would do with something like this. AMD, 1, 2, 3, 4, 5, very close. I don't being a base. In fact, if you love the name, I think you could uh quote unquote cheat and just say, hey, this is a base. So hopefully you get a few more days sideways for AMD. Microsoft, again, if you own them, you can leave them, but there's not a lot you can do with any of these names really if you want to initiate. Elf just continues credible action, really, really good stock. I remember thinking it was a sell on an upper channel line, and maybe I was right for half a minute, but I should have been more interested in finding a way to get into that one. Lilly, powerful, needs some sideways action, needs the moving averages to catch up. And Chipotle. So what 1, 2, 3, 4, 5, 6, 7, 8, 10, 12, 14, 16, 18. And then last but not least, Snow. Those are 20 great stocks. Great, and some of them are incredible. So, this whole talk about the breadth, I just don't think it holds water. And I'm sure there's plenty of stocks that I didn't talk about. So Snow, I think this is going to be 3 weeks tight? No, might miss. 1.27, 0.42. Look, the spirit of the rule. That looks like 3 weeks tight to me. I do have a position in Snow, FYI. And then you have earnings in 5 days. I probably will sit through earnings. I don't know about the size, but I normally sit through earnings if I like a name. All right. So let's jump to quote of the week. And I know I talked about this. I wanted to show this to you a few weeks ago. I think I mentioned it, and I decided, I'm just going to make this my quote of the week. Now, the highlighted areas are my highlights, FYI. It's hedge fund letter from Genesis Macro. They had a drawdown of 18.8% in the first weeks of January. As such, I'm making the painful decision to close the fund. I guess he had a really good track record as before, like of doing pretty well. He was, and I'm assuming it's a he. I apologize if I got that wrong. The fund was long China and short Japan. That was their pair trade, so to speak. And they got it quite wrong, unfortunately. It's one thing to get one wrong, but when you get them both wrong and it's a pair trade, usually people, when they do pair trade, they put it on in size. Because on paper, it's if I'm long the NASDAQ and short the S&P, it's really hard for me to make a ton and really hard for me to get run over, right? Because the correlations are just going to be super high. I don't know what it is for Japan and China, but it's, close enough. And they thought that China was oversold and putting words in their mouth, and Japan overbought. And these are dangerous words, overbought and oversold. But what's important to me is what he said. He said, and I can appreciate his candor. I have reached the stage whereby my confidence as a trader is lost. If you lose your confidence, and I can tell you, in 25 years, there's been a few instances where I've lost my confidence. I was on the brink. I was like, I just don't know if I'm ever going to make another dollar in the stock market. It just felt like no matter what I did, it was wrong. And you have to protect that. You got to do everything you can to stay out of that mindset, that that mental capital. And even if it means giving up upside, and that's a lot, partly why I tend to take off on the way up, is because I'm always wary of drawdowns uh, draining my mental capital. So that's why I tend to try to smooth out my returns a little bit on the way up and the way down by by being hyperactive, honestly, with the positions and trimming them, cutting them, reducing them, adding here, oh, I'm wrong, take that off, etc. Just try to protect your confidence, because if you lose your confidence, you could get knocked out of the box for good. He says, the recent period has proven that my past experience is no longer valid and instead is working against me. So I think Bill O'Neill would say experience is no good if your experience is bad habits. And so there'll be periods where the market, you're just in sync and everything you do is the market is just, you're just printing money. And there'll be periods the other way where you can't get anything to, you'd get insider, the CEO could tell you something about the stock and you'd get it wrong. It's just, you just can't get it right. And and Nassim Taleb in the book Fooled by Randomness would say that it's a lot of his luck. There's both good luck and bad luck. So we tend to give ourselves too much credit when things are going good, and we don't allow for the fact that it could be a little bit of luck. Like, I started in the business in 1995. I opened my first account in March of 1995. I took that small amount of money up like 28-fold in 1 year. That was luck. A lot of it, if not all of it, was luck. I was using a lot of leverage, and we were in a bull market, and I showed you that on the chart. So we give ourselves too much credit when it's good, but we also give ourselves too much blame when it's bad. You just could be, if you were in Palo Alto, the stock looked fine. It didn't give you there was no clue based on the trading action that the market was going to react that poorly to the earnings report. So that's just bad luck. And that you can't overcome those. It's just out there. Which is why I think you have to be flexible and willing to change with the market a little bit as the market changes. I have lost my knowledge, trading, and psychological edge. Back to the first one, confidence. You lose your edge. It's very, very difficult to trade properly, invest properly. I underestimated, and this is the key word, underestimate, because the market can and will do anything. A lot of people if you hear this, like, about the moves that some of these stocks have made, and I always have to remind myself, like, if I'm an SMCI, if I'm long it, it could go down 100 points in a day, easy. And if I'm shorted, it could go up 200 points in a day, easy. I have to know that's a possibility. I cannot underestimate what could happen to me, so that I'm prepared. How long it will continue? Famous saying, the market will remain irrational longer than you can remain solvent. Trends will persist for a long time, both ways. I still do not understand. This is a key statement. Ed Seykota would say a lot of people would rather understand the market than make money. And so you don't want to forget about understanding why the market's doing that. Just think about, I'm in this to make money. I don't have to understand why NVIDIA did what it did. I don't have to understand what SMCI did what it did. I don't have to understand Chinese macro policy to make money or to avoid losing money. I haven't been in Chinese stocks in a long, long time because the charts weren't acting well. The price action was telling me something was wrong. We made another big mistake trying to pick the bottom. More money's lost trying to pick bottoms and tops. I'm astounded astounded. So you should, I've said that before. I'm astounded by the move that it made, or or something like that. The market can do anything. I could give you 100 examples of charts and things that happened that just beforehand I would have thought no way that could happen, and then it does it, like a Tilray or a Beyond Meat. I remember when Tilray was moving. I just thought this is ridiculous. I was shorting the stock into a climax top, and I was astounded at how bad I was getting run over at that moment. Again, shouldn't have been. Anything can happen. The current economic realities. So macro policy, it's fun, but I'll tell you my experience, you can't make any money as a macro trader. So this is food for thought. I thought there were some really good thought processes in his letter, and I think we can all learn a little bit from what happened. And it's rinse and repeat in the markets. You have to have some kind of risk control, as unfortunately this stuff happens. We've seen it from long-term capital in 1998 to was it Bill Wang in a few years ago, who was buying all those stocks, and he got taken out too, margin call, et cetera, et cetera. Okay. Market Smith at investors.com, 800-424-9033. One more week of Market Smith. I don't think there'll be a video next Friday because Harold and Arnie will do their monthly webinar on Thursday. And then we launch Market Surge the following week. So we're so close, so close. It's exciting to finally have it here. So, but 800-424-9033 or Market Smith at investors.com to reach us. Have a great weekend, everybody. Talk to you soon. Bye-bye.